Micron Bitcoin ETF provides investors with a regulated pathway into the cryptocurrency market.
When you're ready to take your investments to the next level, you might want to consider Monaco.
Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Great you can join us here at ausbiz. Well, global stocks consolidated gains overnight as investors look to lower interest rates. Bond yields and the US dollar fell in response to soft US retail sales data, which pushed the S&P 500 and NASDAQ to new records. Nvidia overtook Microsoft to become the world's most valuable company. Shares of the chipmaker climbing to $135, lifting its market capitalisation to $3.34 trillion. Nvidia stock has nearly tripled so far this year, compared with Microsoft's 19% gain, as demand for processors outpaces supply. Other chip stocks, including Qualcomm, ARM Holdings and Micron, also extended their recent rallies, pushing the semiconductor index to a new record high. Shares of education tech provider Chegg rose after announcing job cuts in a restructuring, and home builder Lennar fell after forecasting lower than expected third quarter home deliveries. Well, US retail sales rose just 0.1% in May, while the previous month's data was revised down to a drop of 0.2%, suggesting that economic activity has remained lackluster in the second quarter. However, industrial production beat estimates, rising 0.9% from the previous month. Markets have also responded to comments from a number of Federal Reserve members, with New York Fed President John Williams saying, "I expect interest rates to come down gradually over the next couple of years, reflecting the fact that inflation is coming back to our 2% target and the economy is moving in a very strong, sustainable path." While Dallas Fed President Laurie Logan said, from a monetary policy perspective, "We're in a good position. We're in a flexible position to watch the data and be patient. We're going to need to see several months of that data to really have confidence in our outlook that we're headed to 2%. Well, US Treasury yields fell on the release of that retail data, the 2-year down to 4.7% and the 10-year was down to 4.21%. And the US dollar eased against most major currencies, with the Aussie trading at 66.6 US cents. Well, earlier I caught up with Tim Richardson from Pengana, talking about the global economy with a focus on what we're seeing out of Europe at the moment, particularly that political instability.
Have had a pretty good run over the last 6 months. I think though when you look at the markets, it's probably best to not look at them as a single lump. What we've seen is those companies that are aligned to those structural growth trends in the economy, artificial intelligence, the energy transition, onshoring, the wealth shift. Those have been able to grow their earnings, deliver some really strong free cash flow, and that's been reflected in the share price. But on the other hand, there's a bigger lump of the global share market that hasn't seen that multiple expansion, and the valuations are looking less stretched. So whereas global equity investors have certainly had a good run, unless there's a recession coming that's not generally factored in, it's hard to say that we're in a bubble territory, although of course that's not to say that investors shouldn't expect those periodic 5 or even 10% corrections that are just a normal and some would say healthy part of stock market investing.
Where are you seeing, when you say, obviously some markets where those valuations are stretched, others are not, where are you seeing that? Is that sort of providing some opportunity at the moment, do you think? It's not to say that those companies that have seen the really exciting earnings growth are overvalued, and it's not certain that their future growth prospects aren't fully factored into the pricing at the moment. But we're starting to see a bit of a broadening of the recovery in share prices. And what's
probably worth mentioning is global small companies. They've underperformed quite significantly over the last year or two, as global small caps tend to during periods of elevated interest rates. As interest rates start to come down, that's the point that those sorts of quality smaller businesses with sensible levels of gearing can really outperform, and you're starting to see some signs of that over the last few months.
Tim, let's focus on Europe. Now, of course, a lot of political turmoil there, in particular in France, with Emmanuel Macron calling parliamentary elections. There's a fear, I guess, in some markets that this lurch to the right politically. What's the effect of that? How's it playing out?
Well, you saw that in the markets last week. The fear that that Macron's snap election after his disaster in the European Assembly elections could lead to a populist-led government under a populist prime minister with a period of cohabitation. That's the sort of environment that you could see a really strong loosening of the fiscal policy, which is which is already relatively loose. Bond markets reacted very, very badly to that. You saw the big spike in bond yields, which transmitted into the equity markets, focused on France, but you also saw a spillover into the wider European markets. Last night we saw the Eurozone inflation data headline was unchanged at 2.6%, and the core inflation stayed stuck at 2.9%. That was in line with expectations, but that's not really going to do anything to resolve the underlying tensions of that political turmoil. Feeds from the fact that a lot of people in the French economy are hurting. They've got some really unpleasant cost of living pressures as inflation went up over the last year or so, and interest rates are still high.
How supportive do you think monetary policy from the ECB is likely to be? Obviously, they cut the last meeting. Are we expecting further cuts?
Yeah, that's right. They cut by 25 basis points at the meeting earlier this month, which was in line with expectations. They've dropped some pretty clear hints that's the first of a series of rate cuts. But what we shouldn't expect is that this interest rate cycle to be symmetrical. On the way up, it was quite rapid, the sequence of interest rate rises. The ECB, and I think this is probably going to be reflected in other central banks as well, they're going to be much more gradual on the way down. So it may well be that we've got to wait another meeting or two before we see the next rate cut.
We've also got the Bank of England and its decision this week as well. What are you seeing in the UK economy at the moment?
Well, the UK economy is certainly under the same pressures that you're seeing across the European continent. Markets had been pricing in some likelihood of a rate cuts at this meeting. Sticky inflation data seems to have pushed those expectations back a bit. The UK, of course, has got the additional factor of a general election, and the result of that is fairly widely agreed. There's likely to be a change of government, and that in itself always creates a bit of uncertainty. But the new government will have very limited fiscal space, so the general drift of macroeconomic policy is likely to continue. That should give the bank scope for rate cuts a little bit later on this year.
Across the Atlantic, how are you viewing how the US economy is tracking at the moment? And obviously we're in the midst of a lot of Fed speak at the moment too, aren't we? Which is always interesting as far as what and that actually amounts to. They can talk the talk, I guess, but do they walk the walk? Markets are expecting one, possibly two rate cuts by the end of this year. Every time a Fed speaker pops up or every small piece of data is released, the likelihood of that expectation moves up or down. But looking at the bigger picture, the US economy is still doing pretty well. There's full employment.
People have got money to spend. There is some pain in the economy, particularly the lower income demographics, and people are struggling to get on the housing ladder if they're not already on it. But in aggregate, that economy continues to do well. Corporate earnings growth is very strong. Business investment is strong. So perhaps what that means is the Fed's in less of a hurry, feels less pain, to cut interest rates than some other central banks.
So Tim, from an investor perspective, now of course we're heading towards the end of the quarter. What is that and we do see some movement in portfolios as a result. There's maybe some tax loss selling at the same time. What do you think the most likely approach is here as far as your portfolio is concerned, given the backdrop you've just painted macro-wise?
Well, at Pengana, we're long-term global equity investors, so we don't tend to make portfolio moves based on short-term, macro data. Investors should take their own advice for their own particular circumstances, but I think global equities at this point have a role to play in the portfolios of most long-term investors. I think investors should continue to focus on those parts of the market that are delivering earnings growth, particularly those that are aligned to growth trends such as AI, the transition, onshoring. Look for companies with strong balance sheets that are able to refinance debt, invest in new products, regardless of the credit environment and at any point in the cycle.
What role does fixed income have at the moment?
Fixed income has a role for a lot of investors. If you look at the yields that you're getting on, say, 5-year debt in the US or the other major economies, the headline number looks good. The counter argument is, look what you can get on a term deposit. But as interest rates start to roll off, those sorts of rates on short-term money won't necessarily be there forever.
Tim Richardson from Pengana. All right, let's take a look at where we're likely going on this Wednesday. And SPI futures indicating will be a soft open there, down just 8 points. Stay with us because the open is just a couple of minutes away.